Welcome back, best ever listeners, to the Horizon podcast. So I wrapped up my little travel to New York and spent a couple days in Miami for the eCore conference. That all went great. Had some great conversations with a variety of investors across the East Coast over the last couple weeks, and got some useful information. I think that there's a lot of things that are starting to happen in the industry, and it's pretty exciting. I think that the flow of capital into commercial real estate as a whole is picking up. So my next stop will be the Globe Street Healthcare Conference on December 2nd in my hometown here of Phoenix. So I'm looking forward to that. If you happen to be in town and you happen to be at that conference, please come by and say hello. So let's see here. We just got the September jobs report. So that's been delayed by the government shutdown, but I'm going to dig into what those numbers are telling me, and I think there's a lot in there. So, but first, just a reminder, join me at the Best Ever Conference in Salt Lake City. I will be presenting on February 18th at 9 a.m. in the morning. I am the lead off batter, so I'm hoping to have a full room there. Get everybody in there for that kickoff. I'm going to focus on my 2026 outlook for commercial real estate and why I think we might be on the leading edge of the next real estate cycle. So even though there's a lot of challenges and headwinds out there, I do think that there's a lot of opportunity for investors. I think the numbers are starting to make sense. And based on my conversations, I think the capital is going to start to flow. So just remember, you can use podcast 10, all caps, for a 10% discount if you register for the Best Ever Conference on besteverconference.com. So I'm John Chang, and I've been active in real estate for most of my life. Since 2007, I've led the research and advisory services team at Marcus & Millichap, the leading commercial real estate brokerage company. Now, as I do every week, I'm going to say it again. I'm doing this podcast independently, and what I say doesn't reflect the opinions or positions of Marcus & Millichap. So, like I said at the beginning, I'm going to focus in on some of these, the new jobs numbers that just came out. Now, these are for September. They just came out this last week. They were delayed by the government shutdown. And so on the surface, stronger than expected, added 119,000 jobs in the month of September. Now, we will not be getting an October employment report. It just won't exist because the government was shut down for the entire month of October. So they did not gather any of the data for the employment report for that month. So it's just going to be a blank. It just skip. And at the same time, we're not going to get inflation data for the month of October either. We got September already, and we have CPI at 3%, but we won't get any numbers for for October, sorry. And even the November numbers for the November jobs report and the November inflation report will be delayed into December. And from what I'm hearing, we won't get any of those numbers before the next Fed meeting. So I think that's December 10th. So it's going to be a bit challenging. The Fed's going to be making some decisions with very little information, which is not a place they like to be. So September, we added 119,000 jobs, but July was revised down by another 7,000, taking that month down to a plus 72,000 jobs for July. August was also revised down. It was reduced by 26,000 jobs. So August came in with negative 4,000 jobs. Now, that is the second month recently. I think June was negative and now August was negative. So we're dancing on the edge. Unemployment rate ticked up 10 basis points to 4.4%. And so year to date hiring has totaled about 684,000 positions. Now, as I have been preparing for the healthcare conference, I was digging into some nuances of the employment data. And I have a graph for this, but I don't know that I can get it included for the podcast. It's pretty predominantly audio. Basically, in the first 4 months of the year, right? So President Trump announced the tariffs on at the beginning of April. And so, most companies didn't respond immediately, and their employment for April was kind of already baked in. So in the first 4 months of the year through April, healthcare employment, the healthcare sector added 98,200 jobs. All right. And all the other sectors combined, that's, government, manufacturing, construction, professional business services, retail, basically all these other sectors combined, we added 392,800 jobs in the first 4 months. So 98,000 for healthcare, 392,000, 393,000 for everything else in the first 4 months. Then we put the tariffs in play. And so then in the following 5 months, May through September, okay, healthcare actually picked up a bit, added 214,000 jobs, but all of the others combined was negative 21,400. So basically, in the last 5 months that we have jobs data, if we hadn't had 214,000 jobs created by the healthcare sector, we would have been negative for that 5 months. And that's not a good thing. That means we're now running on way less cylinders than we were before the tariffs were put in place. We're really just, one trick pony at this point. We have one thing that's driving most of the job creation in the country, and that is the healthcare sector. So that's a bit of a tricky spot, right? Because since we had the tariffs put in place, and also, the immigration policy is another variable that was added in earlier this year, the beginning of the year, but compounded when you take both of those and a lot of the other things that have been happening, and you stack them together, you end up with a lot weaker employment market. If you look at the job openings numbers, I'm going to look over here on this other screen. It's not job openings, it's the total number of new hires, right? So it peaked basically in April when the new hires was running around 5.6 million. And since then, it's deteriorated down to 5.1 million. And at the same time, the number of separations has tumbled as well. That's down to 5.1 million also. So basically, we're hiring 5.1, we're shedding 5.1, and this is as of the August data. I haven't baked in the September numbers yet. But basically, because of the uncertainty, businesses have stalled out their employment, their hiring efforts. And because of the uncertainty, a lot of businesses are putting decision-making on hold. And so it's really starting to weigh on the economy. If we had clarity, if we had transparency, if we had, straightforward decisions, like if in April, President Trump said, all right, that's it, not happy, 15% tariffs across the board, done, right? We'd probably already be over this hurdle and be moving on. The economy would probably actually be doing a lot better because that uncertainty would have spiked and dropped. And we'd be moving back into pretty much a normal climate. We'd adapt to the tariffs. We already are. The problem is that they keep getting rejiggered, right? Oh, this month it's going to be this percentage on this country. And then we get mad at another country. We throw tariffs on them or increase the tariffs or, the, what was it? The governor of Ontario throws up an ad with a Ronald Reagan quote. And all of a sudden, President Trump's throwing higher tariffs on Canada. This kind of a policymaking environment has no transparency and no predictability, right? You can't predict what's going to happen next. So basically in that environment, everybody sits back and waits. You do what you have to do, right? If you lose a key person, you need to replace that key person. You do that, but you're not growing your labor pool at your company, generally speaking. Most companies aren't doing that right now. So that's making the hiring market more challenging. I'm looking at my talking points, and I just ran off onto a tangent, as I normally do. Oh, I was talking about healthcare jobs. Healthcare, basically, it's in tough shape right now, and so going forward, the ability to hire people for healthcare is going to lose momentum, and there's a couple reasons for that. Right, there's a finite pool of people who have the appropriate skills and training to go into that job. And so once you tap it out, what do? You look around. Oh, you could hire people from out of the country, right? You could hire new immigrants to the United States who maybe have those skills, except with a tightened immigration policy, we have far less immigration. And with the increase of the cost to do an H-1B visa to, I think it was $100,000, a lot of these companies and a lot of healthcare businesses say, well, we would have hired a nurse from overseas and brought that person here to work in that job, fill that role that we couldn't fill with local talent. But at $100,000 a whack, not going to happen. So we could face headwinds in creating jobs, right? The openings may be there, but you don't have a person to fill that job. So we could lose momentum in the healthcare field. The other sectors have also lost momentum. And this isn't just policy, right? Some of this is also the impact of AI. Right. We keep hearing about that. You look at Amazon, for example, declaring, significant layoffs. I think they started with 14,000 jobs, I think is their first salvo. And they're saying, hey, look, we can do stuff with AI that we would normally throw bodies at, and we're not going to do that anymore. We overstaffed a little bit. We're cleaning house and we're going to get, right sized. So that's going on as well. So the other thing is we're starting to see increased layoffs. Now, again, the data is a little spotty. These are from like Challenger, Gray, and Christmas and some of these other recruiting firms that track the layoffs. But they're saying that that's on the rise. And so I guess, as I said earlier, we're dancing on the edge of this thing. And it doesn't take too much to get blown over the edge. I'm not saying we will. I'm not saying that, we're going into a recession. Right now, very few economists are saying that a recession is more likely than not. Right? I keep seeing things like 35%, 40%, 45%. The economists out there are kind of like, well, we don't know. Toss it somewhere in the middle, maybe 45, 50%, whatever. The point is that nobody really knows. And so we just know that it's not far off, and it wouldn't take much to get there. So we're creating policies that are not growth oriented. All right. So tariffs are not a growth tool. They're a tax. And so you slow down economic growth by adding taxes, right? So historically, if you wanted to create growth, one of the things you might do is create tax incentives. But these are not tax incentives. These are new taxes. And so they slow down growth. Now, the other thing is the momentum for hiring is just not going to get there when we don't have immigration, right? So the Congressional Budget Office forecasts population growth. And I have their growth forecast from January, before these policies were enacted, and I have their recent one, I think, from September. And over the course of 5 years, they've reduced the population growth by 3.5 million people. And so people are a resource for production, right? If you have people working in farming, you're producing more farm goods. In fact, 44% of the farm workers, that sector, right? It includes other things like fishing and forestry, but it's predominantly farming. 44% of the people who work in that field are foreign born, right? They were born somewhere else, they moved to the United States. Construction, 36%. Food preparation, 25%, and healthcare, 24%, right? So by reducing your population growth, you're reducing one of the inputs for business that create increased GDP, right? So between the taxes and the population and the immigration and the tariffs, and some of these other policies that are being enacted, they work against creating growth. And so that's a bit of a headwind. And, is it going to play out over the long term? Maybe. I don't know. I'm not that sophisticated to see how these pieces fit together over the long term, perhaps, but over the shorter term, right? Over the course of the next year, these are all challenges that are going to restrain economic growth in the United States and, as a result, job creation in the United States. And because job creation slows down and economic growth slows down, demand for commercial real estate could be slowed down as well. Anyway, not saying it will. What I'm saying is it makes it more difficult. That's probably the best way to say this. We're putting like hurdles in front of ourselves with these policies. Now, we can still jump the hurdles and we can still make it to there. And don't bet against the U.S. economy. It is by far the largest economy in the world, and the growth drivers are enormous, and the impact of AI should be significant. And there's a ton of other things. All I'm saying is we're sandbagging it. And if we throw too many sandbags on it, it's going to stall out. But so far, it's still moving forward. And so if it were to stall, right, suppose we go into a recession and say, I've been saying for a while, if we do, it's going to be a mild recession. It's not going to be, the global financial crisis all over again. There's just not the drivers that are causing this aren't of that magnitude. So mild recession, not all markets are going to be affected the same way, right? Traditionally, strong growth markets go into recessions last and they come out first. I was looking at Dallas during the pandemic, Dallas during the global financial crisis, and those are the two main recessions. We don't have a lot to work with here. Dallas wasn't quite going as strongly as it is today back in 01, 02 during that recession, the dot-com bust. So using the last two and just focusing on Dallas, for example, Dallas goes in. It's one of the last markets to go in. It's one of the first to come out. Same was true with Florida. Same was true with, Houston, although Houston gets impacted by the price of oil too. Phoenix is another one that has those characteristics. So not all markets are going to be affected the same way. So you could invest in one market and do just fine. And you might be in another one and face a recession, and it could be severe or prolonged. You look at, how San Francisco, this is a really good example, actually. San Francisco is really just now recovering from the pandemic and all that went with it. And here we are, whatever, 4 years later, and whereas Dallas came out, shot, took off, and away it went, San Francisco was more severely impacted and has struggled to come out. Now, the interesting thing is that San Francisco's growth rates on a lot of the commercial real estate demand drivers is accelerating really fast right now. In fact, it has some of the strongest multifamily rent growth of any market in the country. So, again, delayed, but if you time it right, can be a real big winner. Anyway, not all markets are affected the same way. And if we do go into a recession, that could be a headwind for multifamily. We could see a slowdown in demand, right? We could see a slowdown in absorption. And again, if you're in a heavy development market, especially one that's still building, like Phoenix, like Dallas, like Charlotte, Nashville, and if you're still coming out and you still have units coming to market and you go into an economic slowdown, that's a bad thing, right? It means you're going to have that overhang and it's going to be with you for a while and it's going to take time to burn off. But if we don't hit an economic slowdown, if we don't go into recession, those are still markets that are going to keep powering forward and absorb and digest all those extra units and then start to hit that upswing. And that's a key thing. These markets that have stronger growth, once they backfill the new construction inventory, and assuming construction is declines, which it looks like it is, the number of starts, the number of permits, the number of under unit units is all declining significantly down. Starts are down, I think 70%, and units under construction down 50%. So that's for multifamily. There's no real construction of office or retail to speak of, and industrial already slowed down. So self-storage still tapering, coming off of its peak. But the point is that those with growth, those things fill up, and then you hit the expansion cycle more assertively, right? Those high growth markets, once they consume that excess inventory, you start to see vacancies drop very quickly. You start to see rent growth ramp up very fast, as opposed to a slower growth market where it, kind of moves along at a more steady pace. Anyway, I keep saying this, we're dancing on the edge. We could face these headwinds. And now I'm going to jump over into talking about the horizon, right? So now let's take off the hat we were wearing, which is really focused on the next year, 2026, and maybe even the next 6 months with all of that information. And now let's look forward 2, 3, 5 years. And you think about the impact of a recession. Yes, it will impact commercial real estate. Yeah, it's a headwind, but it's not as big of a headwind usually as what you see happen in the stock market or the bond market, or, other investment classes actually have more risk should we go into a recession than the real estate does. Real estate, you have inflation resistance, right? Depending on the real estate, you may have longer leases. If it's a short multifamily recession, your multifamily leases are typically a year. The vast majority of your tenants ride through, you're fine. So your risk factor, I don't know. I'm sure there's some data scientist out there who has a better number than me. But my point is that when I think about it, when I'm looking at it, I think real estate's a better position than a lot of the other options, because real estate moves more slowly, it's more predictable, and you also have value add components to it. So you go through the down cycle, you get into the up cycle, and I think that there's a lot of momentum that builds very quickly, and the performance of a lot of real estate property types are going to do very well in that up cycle. Looking ahead, if you look at the cost of debt capital right now, it's relatively low. If you look at cap rates, they've gone up a bit over the last few years, to the point where you're looking at positive leverage in many cases. And so if you buy into the idea that real estate is a good option to weather a storm, right now is when the pieces fit together best. Because the cap rates are elevated, we don't have the flow of capital into the market that's driving down the cap rates yet. Your cost of debt capital is low, so you have that positive leverage. If you can get in, lock it in, and position into the right assets and the right markets, you're going to be in a good spot. And you're well positioned to weather a storm, and you have a lot of upside potential once we get to the backside of this. So that's what I got. I think, again, I'm biased because, right? Invest in what you know. Invest in things where you can affect the outcome. Invest in things where you have expertise at your disposal, right? I can go buy NVIDIA stock, and Jensen Huang, he's a great CEO. he could do a fantastic job, but I'm not going to influence the outcome of NVIDIA stock or Microsoft, right? Or Meta or Alphabet or any of these great tech stocks that have been doing great. I'm not influencing that outcome. I can influence the outcome in commercial real estate as an investor. So anyway, that's why one of the reasons I love real estate. Anyway, there you go. That's me. That's what I got. Thank you for joining me. Best ever listeners. This has just turned into just this brain dump. And I enjoy having the conversation with you. So again, reach out, send me a note, like, subscribe, tell your friends, hey, you got to listen to this guy. And I appreciate it. So come say hi if you're at the healthcare conference. Don't forget to register for the Best Ever conference. Get that discount code podcast10, all caps, to register if you're going to be able to make it. I'm going to be there. It's a lot of fun. It literally is one of my favorite conferences of the year. The energy, the people, it's just a truly engaging event. And Ben Lapidus is like a master of ceremonies. I mean, he's done great. The whole thing comes together nicely. Anyway, I'll be back next Sunday and every Sunday with the real estate insights to help you understand what's really going on in commercial real estate. So I'll see you next week. And as always, keep your eyes on the horizon.